I mean, it was just one of those things. It was a question of when we were going to start getting drops like this in the Dow, not a question of if.
What do you get when you combine SD bullion and the New Zealand Mint? You get the lowest price silver coin ever released to the world. Introducing the Roaring Lion, a 1 ounce, 4 nines fine silver coin with micro engraving security that retails for lower than some of our competitors sell silver bullion rounds for. Check out this magnificent beast, the Roaring Lion silver coin, at sdbullion.com/roaring. That's sdbullion.com/roaring. All right, all right, all right.
Hey everyone, this is Elijah Johnson with SilverDoctors.com. Eric Dubin co-hosting with us today, and our guest David Kranzler for this week's SD Weekly Metals and Markets Wrap. David and Eric, thank you so much for your time today.
Thanks for having me back on, Elijah. I always like doing this show.
Great being with you, Dave.
All right, now Dave, I'd first like to ask you a question about the stock market this week, because we had the two worst point drops in history for the Dow. Never before have we seen the Dow drop more than 1,000 points in a day, and now we've seen it happen twice this week. What is happening?
Wait a minute, you're saying the Dow was down this week?
Yeah.
And you had to take a vacation this week, huh?
You know, it's I mean, it was just one of those things. It was a question of when we were going to start getting drops like this in the Dow, not a question of if. And everything had become unbalanced to the bullish side, you know, at historical extreme levels. And essentially what the Fed has kind of created is a Frankenstein monster. And you have insane stock market valuations on top of an insane amount of leverage. I mean, you've got margin debt, any way you want to slice up margin debt. I used to see these arguments that, well, margin debt as a percentage of the total capitalization of the NYSE is not at an all-time high. That got to an all-time high. Retail investor margin debt was at an all-time high. The equity level in retail accounts, and this is all data that comes from Schwab and Ameritrade and some of the other online brokers, but the equity value of retail accounts was at an all-time low. And the equity value means the amount of cash, essentially the cash equity value, which means the amount of cash they could withdraw taking into account their margin. Hedge fund equity allocations were at all-time highs. And then you had the complication of the massive short volatility trade and leverage short volatility trade that's layered onto this. And it essentially, it was set up to blow, and that's what we saw. We saw some warning tremors last week. And last week, the Dow was down, I believe, again, this is off the top of my head, it was down about 1,000 points on the entire week, and most of that drop came on, I believe it was Monday and Friday. Again, you know, I'm sorry if I got my days wrong, but and that was kind of a warning shot. Yeah, and then
down on Friday.
That's right. And then, but in the 2 days last week that the Dow was kind of flat to higher was around the time that Trump did his State of the Union speech. So I would argue that, you know, the manipulators were in there trying to keep the Dow propped up in support of Trump's State of the Union speech. And then Monday, I mean, the sell pressure had just built up, and I'm sure there was a bunch of margin calls, risk parity fund rebalancings, et cetera. And we saw what happened on Monday. I mean, I believe the Dow was down as much as 1,700 points at one point.
Yeah.
And then there was the manipulated bounce on Tuesday. And then Wednesday was interesting because at one point the Dow was up well over 300 points, and it ended up closing down 19. And then we saw what happened yesterday and today. So you've just got all these layers of sell triggers that are being triggered. And I mean, I'm sure the Fed's in there trying to manage the decline, but there's just too many holes in the dike at this point.
when we look at the triggers and we, see the Federal Reserve transitioning to Powell with his new administration coming in, I recall how it was when Greenspan came in '87. If memory serves, he came in around April. And then, we had an '87 crash. We frequently see transitions in markets when we have, the people with the Federal Reserve transitioning. Bernanke's tenure and his management of the early phase of the crisis is another example. Did you think that this particular week is reflecting that and other catalysts, like the fact that the credit market is now finally being taken seriously by people who expect the U.S. Treasury 10-year note to stay over 3% in the not-too-distant future is really one of the big stories driving the market. You pay a lot of attention to economic cycles. You pay a lot of attention to real estate and credit cycle. Most people have been watching the stock market and getting drunk on it, but the underlying drivers to this stock market performance has been the largesse created in the credit markets. Where do you think we are in the credit market cycle, Dave?
That's a good question. I mean, obviously, the 10-year yield has popped up a lot. I think, when I started out as a bond trader after business school in 1991, I think that the long bond was like at 9%. And at that time, I remember the head trader on the desk was like, we've had a historical move down in interest rates. Little did we, because at one point interest rates were 21% when Volcker did his thing, and I guess it was 1980. So you essentially had rates going from 18% down to 9%, and little did we know that we would see, a long bond pushing 2%. I don't see how it can get much lower, and it's obviously it's been a function of central bank intervention, money printing, which they like to call quantitative easing, but it's really money printing and buying up sovereign paper and buying up treasuries. So, you basically kind of bottomed out. I mean, certainly the price discovery function in which the treasury curve is supposed to discount the real rate of inflation is not working, because the real rate of inflation is significantly higher than the 2.84% on the 10-year or the 3, whatever it is, low 3% on the long bond. So I think, and again, this is kind of a common belief out there, there's going to be kind of inflation that shows up in the numbers that the Fed or that the government can't wash out of the CPI. And I think the market's going to start paying attention to that. And so I think we have a lot more downside in bond prices, treasury bond prices, and a lot more upside in yields. And to compound that factor, essentially what you've got is the tax cuts are conservatively estimated to cost the Treasury about 1.2 to 1.5 trillion. And then you just had this 2-year budget deal passed that's going to add north of $1 trillion to the on the books budget. So that would suggest that the Treasury is probably going to have to issue, close to $2 trillion in treasuries this year. And I don't think that the traditional buyers of treasuries are going to like that very much. Certainly Moody's fired a warning shot this morning when they put the U.S. government's credit watch on downgrade. So, again, I think the interest rate factor is beyond the Fed's ability to control it unless they were just to go into Weimar printing mode on steroids in order to buy up all the treasuries that the Fed's going to have to issue, because I certainly don't see China and Japan and some of our traditional buyers stepping in front of that freight train, because it's just the more they issue, the more the market's going to back up, and you're guaranteed to lose money.
And this is all happening at the same time that central bankers around the world are speaking about, quantitative tightening and reducing balance sheets. It's just a recipe for disaster. They're not going to be able to pull it off.
I agree.
Now, regarding the correction we saw in the stock market, do you think the stock market has further to fall because it's, down almost exactly 10% from its high, which, makes it officially a correction now, and the mainstream media is saying, well, it's a correction, but is it going to be a full-blown crash?
That's another really good question. And again, I think it's going to be largely dependent on the ability of the Fed to prevent a crash from happening. I mean, if you just look hard at the numbers and realistically at the numbers, the S&P could fall 50% from here, and it would still be on the overvalued side based on, just historical PE ratios. And you can do that with price sales, price book, whatever metric you want to throw in there. People like to use the Shiller CAPE. Then there's margin adjusted CAPE. Well, any metric that you want to use, the stock market could get cut in half and it would still be overvalued. So I hate to make a prediction that we're going to fall 50% from here, but I would not be surprised if it happened. And the only reason I don't think it would be that the Fed figures out some way to keep this thing from falling that much. I mean, if the stock market were to fall 50%, it would, I think you'd essentially see the equivalent of financial nuclear Armageddon in this country. Pension funds would blow up, real estate would crash. I mean, it would be a complete disaster. So whether or not that's preventable, I don't know. That remains to be seen.
And do you see any changes within the Fed because of the new Fed Chairman Jerome Powell?
No. I mean, again, as Eric kind of alluded to, you didn't say it explicitly, they've been sitting here talking about reducing the size of their balance sheet. And up until 2 weeks ago, they were about 10 or 20 billion behind schedule on that already in the first 4 months, and they're on the lightest part of their balance sheet reduction schedule. 2 weeks ago, they pulled 21 billion of liquidity out of the system. They reduced their balance sheet by 21 billion, and then I don't think it's necessarily coincidental that that's when the tremor started happening the following week in the stock market, and I don't think it's coincidental that it.
Million or billion?
Pardon me?
21 million or billion?
Did I say million?
Yeah.
I meant to say billion. 21 billion. So, and I didn't look yesterday afternoon. The latest balance sheet was out yesterday afternoon. I was tied up doing other stuff. But, the balance sheet reduction is supposed to, again, I don't know specifics. I haven't paid that much attention because I just don't believe it's going to happen. I think they're supposed to start doing 30 billion a month now, starting this year. And I just don't see that happening. I think if they were to pull 30 billion out next week, I think you'd have a disaster in the stock market. So, pardon me?
The psychology of that would be pretty nasty. No, I think they're still in the 10 billion range right now. At least.
Okay. So in terms of whether or not there's going to be a change in policy, I mean, there's such a difference. There's such a differential between what the Fed says they're going to do in public and what they actually end up doing, that, rather than, looking at what everyone thinks Powell's going to do with the Fed, I'd just like to sit back and see what the actions are, and then we'll know. I honestly don't think there's going to be much of a difference.
It was interesting back in 2012 in one of the FOMC meetings, Powell was on record in the minutes now that had been, I think it was released last November, where he was openly talking of grave concern about how the suppression of volatility in both credit and stock markets were going to bite the Fed. And this is way back in 2012 when they were only just beginning to get, their moxie going, suppressing the VIX, et cetera. It's interesting that reveals that the guy really is a truth teller when he's behind closed doors and he understands what's going on. But now that he's sitting with the responsibility of managing the Fed, and his name is going to be in the history books, he's probably going to be just as aggressive when it comes to liquidity as any other chairman prior to him. But it'll be interesting to see because the powers that be know that this bubble exists, whether or not they want to deal with it in some kind of proactive way by, for example, letting interest rates rise and not fighting it as much, or at least attempting to fight it, whether or not they're even able to, will definitely be interesting to see.
Now, moving on now to the precious metal markets, this week was also not good for them. What is your perspective on why we're seeing a drop also in gold and silver?
Well, I mean, in my last mining stock journal, it was dated January 25th, I actually told my subscribers, I said, look, I think they're getting ready to take down the precious metals again. And, again, coincidentally or not coincidentally, gold actually started moving lower, as did the mining stocks, just using the GDX on that day. Now, I wasn't really paying attention to what it did that day when I said that. What I look at is the COMEX paper gold open interest, and the paper gold open interest had gotten back up to around 600,000 plus or minus, and that's usually been, and also that in conjunction with the net short position of the banks per the weekly COT report, and that's usually around, a signal that they're going to start working to push the price of gold lower, trigger hedge fund stop losses, and print their profits on the shorts that they put on. So it's not surprising to me that the sector has had a huge pullback, and I think that it's still got a little bit more legs left to it. I think we're going to see slightly lower levels, although I think the mining stocks themselves, I think the severe or the rapidity of the decline is probably going to slow down here. The mining stocks are pretty much in relationship to the price of gold, pretty much as oversold as they were in December 2015 when the market bottomed and we kind of started on this current up leg that we're in. So the open interest as of yesterday was around 525,000 contracts, and I'd like to see about another 50 to 75,000 come off of that. Now, part of what prevents them from pushing down the market even more quickly is the physical bid for physical gold coming out of the Eastern Hemisphere, mostly India and China, but there's plenty of other countries that are buying a lot of physical gold. China celebrates their Lunar New Year starting, I think, next Thursday, and their markets are basically shut down for a week. And I've been kind of looking at that as maybe sort of the last hurrah that the banks will use to push the price of gold lower to try and get the open interest down and print their profits. And the last several cycles like this, the open interest has kind of bottomed in the 425 to 450,000 contract range. So that's the level where we'll start putting the cash that we raised over the last month back to work in our fund, and that's when I'll start to get bullish again on the sector.
One thing to point out to our listeners that is useful, if we look at the trading last week, a lot of people will talk about how there's margin calls that come in and then people rush to gold just to get some liquidity to cover their positions and whatnot. If you look at the trade last Friday, when we did have that down day on S&P 500, 666, or rather the Dow down 666 points. When margin calls come in on that kind of trading within equity positions, and yes, people would be pressured, they need to go and get cash, but there's a time delay with that. We saw gold being pressured when the stock market was crashing downward. That's more of an indication of manipulator footprints than margin call action, just because of the timing of it. And, this week we saw a little bit of pressure probably coming in from distressed sellers. They do exist, but we have the gold cartel keeping a lid on precious metals, as well as coming in and probably buying stock futures and trying to support the market, as well as buying bonds. They're very active in periods like this. So we see a little bit of everything that comes in and keeps precious metals under wraps because of fear of Alan Greenspan's fear barometer making matters worse.
That's a good point, Eric, and especially in terms of the hedge funds unloading positions. The hedge funds are out there.
It takes them time to cover.
Pardon me?
It takes them time to cover and process their book. When they get a margin call on Friday, they don't have to sell something literally on Friday. They got till Monday.
Right, and then you probably also are going to see them selling, to head off margin calls. I think. And
if anything, if they have the luxury, they're not going to be pitching or their gold. They're going to hold that as long as they possibly can. So the whole argument about rush to liquidity being the reason why precious metals go down when we see action like we've seen in the last week and a half, it's bunk. Friday's action is prima facie evidence of the Federal Reserve and the Working Group on Finance and all the other creatures pushing gold down, because it just doesn't make logical sense.
That's right. That's right. And again, it's all done in the paper market. I mean, just about every day that gold has been red when the U.S. markets are open, it's actually rallied and it's been green overnight when Asia's in there buying. And those are the physical markets. And then, you can see if you look at overnight charts of what gold did, you can see where it transitions from being up to selling off. And it usually starts around the AM London fix. I mean, in my opinion, London has primarily become a paper market, just like the COMEX.
Yeah.
Now, I will say, and I put this in my mining stock journal that was just released last night, I've been watching, I haven't really been an aggressive buyer of silver or silver stocks for the last several months. And I'm watching the price now. I mean, the future's at 1624. If they can get silver down to the $16 level or even below, that's when I become an aggressive buyer of silver, personally, and for the fund I manage. And also, I've got a handful of silver stocks that are on a list that we'll load up on with some of the cash we raised, because I think silver at some point is gonna start moving back up a lot quicker than gold will.
All right, now moving to the last topic we had on our list was about the housing market, because you recently wrote in your on Investment Research Dynamics that the rising 10-year Treasury yield will be bad for the for the housing market. Can you expand on that?
Sure. Well, essentially what we've had, for the last 5 years and really the last 2 years is a large majority of the current home buyers have been using these Fannie Mae and Freddie Mac 3% down payment, low to no PMI insurance mortgages to buy their homes. And what they do is they maximize the amount of monthly payment they can afford. They go out and they stretch their after-tax income and figure out exactly what the maximum monthly mortgage payment they can make and still qualify for the mortgage. It's like, these buyers are buying a monthly mortgage payment rather than buying a home. And you're going to see, we saw just, small upward movements in interest rates have affected home sales measurably. The NAR blames it on low inventory, but that's nonsense, because I have data in a chart that I posted on my blog, most recently a couple of weeks ago, that shows going back to 1999, there's an inverse correlation between inventory and sales. So when you have low inventory, it tends to stimulate sales because everyone's worried about not being able to find their dream house. So they, and then the exact opposite happens as inventory rises, sales start to decline because all of a sudden potential buyers see a lot more homes coming on the market. And it's like, okay, I'll wait and see if prices come down. And I'm starting to see that effect in Denver already, where we're starting to see prices come down. And I also have another chart that I'll put in my short seller journal this week, and it shows there's essentially pretty close to a 1-to-1 correlation since 2000. I think I took it back to 2009 between household debt and home prices. So rising household debt, which is now at a record level, is directly correlated with rising home prices. And as interest rates rise, and it hasn't taken a very big rise to affect demand for housing, as the 10-year starts to go over 3%, it's going to really crush the ability of the average middle-class person to be able to afford a home. And I think we're going to start to see, while the household debt level may continue higher, I think we're going to start to see prices start to turn south. And at some point, flippers holding inventory are going to freak out, and they're going to look to dump their homes that they're sitting on. And it's going to be a vicious feedback cycle like we saw in 2007, 2008. What's very interesting is that the Dow Jones Home Construction Index, which is the index I use to monitor essentially, the home builder industry, it's down about 18% now in the last 2 weeks. And that, so it's like, people like to throw terms on percentage declines in a stock or a sector. So it's well beyond the correction phase, and it's approaching a bear market. And it's interesting because I haven't seen anyone mention that in the financial media, of course.
I just pulled up the chart, too. It's pretty telling. I mean, from September all the way to, eyeballing it, and pretty much the end of January, it's almost a 40-degree line of appreciation with huge momentum. Technical analysts begin to get really nervous when, for example, relative strength index is over 70. It's like almost 90 through many of these months. We have had what is, in essence, kind of a blow-off top in the passions for equities, and this is expressing it, too. So when we see interest rates being the primary cause of everyone freaking out, this is the kind of asset that or index, rather, that will reflect it a lot quicker. It's fascinating. We should put this in the write-up, Elijah, just to give people perspective on how interest rate sensitive sectors move fast when there are phase shifts in markets. Everyone's asking whether or not this is a new boom up, a bear market for equities and bond markets, and the markets are pricing that in. This is the initial phase of pricing in of that kind of a freak out. And we've been going 9 years, one of the longest economic cycles of expansion we've ever seen, and it's been partially artificial the whole way through. With all this fake liquidity, upwards of $300 billion per month coming in from central bankers last year. It was just quite a party. And someone rang a bell. They say they never rang a bell, but I heard a bell. It's
more than one bell this time around.
Yeah, well, the everything bubble has more than one bell.
All right. Well, Dave Kranzler and Eric Dubin, thank you so much for joining us today, and we'll definitely put a link to that index then into the description of this video so people can go take a look at it. Before we let you go, David, did you want to share with the viewers any last thoughts you had and where they can find you online?
Sure. I think it's, hold on, it's going to be a wild ride. I mean, I'm just looking at the market indices right now since we've been on, and the Dow's now up almost 200 points. I mean, it started the day up over 300, and then it was, forget how far it was down. I mean, it had a 600-point swing, so it was down about 300, and now it's back up to, well, now it's only up 170. So, I mean, it's going to be a wild ride, and ultimately, I think there's a lot more downside that we're in store for. My blog is investmentresearchdynamics.com, and on there you can find links to my mining stock journal and short sellers journal. And last week I was kind of heavy on home builder short ideas, which have done well this week, and also Amazon, which has just gotten hammered this week.
All right. Once again, David Kranzler, thank you so much for your time today.
Thanks for having me.